So now we're going to talk about buying a put option to insure an existing stock position. So that's the long put insurance strategy. Here's an overview of what we're going to cover. So are we bullish or bearish on the stock? Well, we're actually still bullish on the stock. So in this situation, we actually own shares of the company. So we still want the share price to rise. But what we're doing is buying a put option for downside protection. So remember, put options go up as share prices fall. So the idea is if the share price does fall on us, the losses on our stock position will be offset by the profit made in our put option. And there's a cost to buying this put option, so it's a debit. Let's get through an example now. We currently own 100 shares of Microsoft at $47. Today it's trading at 56.38. So at the moment we've got a $9.38 per share profit, which is quite substantial. Now we still think though that the share price is going to rise to $65. So we don't, but at the same time we don't want to lose any of the profit we've made, just in case we're wrong. So we decided to go and have a look at the put options that are on display. So we're looking here at the moment at the put options for Microsoft for three different expiries for May, July and January. And we've decided we want to buy about 3-month insurance on this particular position. So we went out and we bought the $55 put option, and you can see the cost there was $171 for that particular trade. So we'll go and show you what that looks like now in this example. So in essence, we've got two trades done now. We've bought the shares of Microsoft at $47, but we've also bought one contract. Now, the reason we bought one contract is because we own 100 shares of stock. So buying one put option contract covers that 100 shares in terms of risk with the put option. So we bought one contract at the Microsoft July $55 put and we paid out $171. So our total cost is the cost of our shares, which is $47, plus the cost of our put option, which is $171. So our net cost now is $48.71. So here's the first, I suppose, downside of the put option strategy. You can see that your net cost has gone up. So if you didn't buy your put option, your cost would only be $47 per share. But now because you've bought a bit of insurance, your costs have gone up. But you've got to weigh up whether or not you would prefer to insure your stock position or take that risk of share prices falling. So that's a decision only you can make. So what does that mean? It means now that we have the right to sell our shares to the put option seller at $55 between now and the expiry in July the 15th. So that's the plus side for us. No matter what happens, we get to sell our shares at 55. Even if they fell to 40, we still get to sell them at 55. So that's the bonus of having the put option. That's the real benefit of it. It's a really big insurance policy for your stock position. So what's the risk? Well, in reality, in this particular example, we've no risk in this trade anymore because now we're guaranteed to sell our shares at $55. So our net costs, including the cost of buying the put option, was only $48.71. So that means there'll definitely be a profit in this trade. So we're now guaranteed to keep it. But if you bought a put option at exactly the same time as you bought the stock, in other words, there was no profit in the stock yet, your risk would then be the cost of your stock plus the cost of your put option. So what's our max profit? Well, our profit is technically unlimited with this because if the share price keeps rising, obviously the value of our stock keeps rising and our profits keep going up. But remember, in this example, we said we're going to sell our shares at 65. So let's use that as a proxy for estimating our max profit. So therefore, our max profit is our selling price minus the cost of the shares, which is $48.71, including your put option. So that leaves you a profit of $16.29 per share, which is quite substantial. So please note, you would have made more profit if you didn't buy the put option. You would have made a lot more. But the downside is you wouldn't have been protected from downside risk. So again, this is a trade-off only you can make. You know, in life, you don't get car insurance for free, you don't get health insurance for free. And when you're insuring your stock position, you don't get it for free either. So that's a trade-off you've got to make. Do I want to insure my stock position, or do I want to generate even more profit? And that's a decision you've got to make for yourself. So calculating your return on investment. Your return on investment is your profit or your loss divided by your investment. So our profit was $16.29. Our investment was the cost of the stock plus the cost of the put option. So our investment amount went up, so our return on investment there was 33%. Now, if you didn't buy the put option and the shares did get to 65, your return on investment would have been 38%. But reserve your judgment on this until you do your profit and loss tables after this piece, because you will see there that if you didn't buy the protection, you would have been in trouble on the stock if the share price fell dramatically. So that's the trade-off and the way up you've got to do for yourself. So what's the break-even point? Well, in this Microsoft example, our guaranteed selling price is $55. So in effect, we've no break-even price because we're guaranteed a profit. But if you'd have bought the stock and the put option at the same time, in other words, there was no profit in the stock, your break-even point is above the price you bought the shares for plus the cost of your put option insurance. So that's your break-even point. The break-even in this case would equal the cost of the stock plus the cost of the put option. So what about managing the trade? Now, we're in the pre-trade phase, so how do you go about picking your strike prices? Well, it's very simple. It depends on what value you want to insure your stock for. So if you want to insure it for more value, use in the money put options. They're going to cost you more, but you'll get more of your share price insured. If you want to insure less value of your shares, use out of the money strikes. Then put options will cost you less, but you won't have as much of your share price insured. What time frame should you pick? Well, we generally say pick the time frame in which you think your shares will reach your target price. So in this example, we had a target price of 65. We think that's going to happen in the next 3 to 4 months. So that's the time frame we choose for buying our put options. Remember, the longer the period you insure it for, the more it costs. So you've got to be clever in the time frame that you pick as well. So what about when you've actually placed the trade? How do you go about managing it? Well, if your share price reaches its target price, it's pretty simple. You just sell your shares for a profit. Your put option is going to expire worthless, and it's of no value to you whatsoever. If the share price does not reach your target price, but's above the strike price of the put, again, you're going to try and sell the put option for a partial profit or loss, so the put option side of the trade, and you might be some value in there, so you'll get to sell that. You get to keep your shares in that scenario as well. And then what you're going to have to do is reevaluate your target price. So do you still think your target price is $65 in our Microsoft example? So in this scenario here, you're going to get to keep your shares. You don't have to, you're not going to be over the 65, but you've got to make sure your target price is the same. What about if your share price is below the strike price at expiry? Well, you've got two choices there. The first choice is you sell the put option for a profit and keep your shares. That's what most people would do 99% of the time. Or the second option, which is very unusual, is where you actually contact your broker and you say to them, exercise my rights with my put option and sell the shares at 55. So you will find that in terms of profit and loss, 1 and 2 are exactly the same. There's really no difference there. That's why most people just go and actually sell their put option, and they'll hold on to their shares or sell their shares separately. So there's two ways of approaching that if you want that expiry. So if you have any questions on this, please don't hesitate to contact us or use the web meetings on a Wednesday night as an opportunity to discuss it in greater detail.